Timing the market versus time in the market. One works, one fails. Which is better for you? Let's talk about it. Welcome to another episode of Millstone River Live, a podcast brought to you by Millstone River Wealth Management. Hey, Adam, we've got a great topic today. Are you up for it?
Yeah, I am.
Cool. So our topic today is a little timely for as we record this in late 2023, but let's be honest, it works all the time.
Definitely.
So what we're talking about is time in the market, not timing the market. So let's talk about what that really means to the investor who's thinking about translating what we just said into what do they earn on an investment portfolio.
Sure. Whether it's a new relationship or, an existing client, when we talk about sometimes the benefits of investing in the stock market, people sometimes hear, that the average annual return of the S&P 500 is, approximately about 10% per year. And if the market is trending up, especially, people say, sign me up for that. But what, as advisors, we run into at times is that in reality, if you go back and look over the last 20 years, how many times did the S&P 500 actually fall at exactly a 10% return? It essentially never does. It's usually significantly higher or significantly lower. That 10% is an average. It's not linear, and that's where the emotions of investing start to come in.
So I've heard it said when talking about averages, if you have two buckets of water in front of you and one bucket is boiling hot water and the other bucket is icy cold, almost frozen water, and you put one foot in each bucket, when you're standing there, is it fair to say, on average, you should feel perfectly fine?
I'll have to use that.
So in investment terms, think about how that works with the emotion, right? The buckets is a little bit easier, I think, to figure out. But when you have market experiences of, big swings, or some people call roller coaster rides, what does that do to the investor's psyche when they look at their portfolio value?
I often refer to it as, volatility investing is the price of admission to, earn long-term successful returns. When the market experiences those large falls, we can feel sick to our stomach as our portfolio values shrink. You said it. It really does feel a little bit like a roller coaster. You've gone over the peak, you're riding that first dip, and your stomach churns. The larger the fall, the more the stomach churns, and the emotions start to take over, screaming, get me out. But those decisions can have a significant impact on the value of your portfolio over the long term.
But if markets are falling and people watch their account values dropping and they say, get me out, isn't that the right thing to do?
Well, here's the issue. That's only one of the two decisions that you have to make. It's, knowing when to get out, but then it's also knowing when to get back in. And that's really the harder part of the decision. And most investors wait too long.
So when someone says, well, get me out, I think what they're saying is spare me any further declines. That makes sense. And then you say, all right, I don't believe that's the right thing to do, but let's say we did it. Now what you're saying is, all right, so now you've gotten your money out of the market, either in part or in full. And now you have to figure out when to get back in. So can't you just wait till the market starts its turnaround and jump back in at that time?
The problem is, though, knowing when. And the issue is that you're still feeling those stomach churning emotions. It's very, very challenging when, we all know people that have gone through the, global financial crisis who unfortunately exited the market sometime in 2009 and 2010 and were still out of the market several years later and missed out on that, entire rebound. There have been 3 bear markets in the past 20 years, and stepping out of the market and moving into cash costs the portfolio. In the past 20 years, if you don't come back in at the right time, it can almost lose half of your potential value.
Yeah, so it reminds me of the old Bugs Bunny cartoons when, or the Roadrunner cartoons when they're being chased across the desert and there's a little chasm in the earth and they want to jump, but, you wait another few seconds and the chasm grows. So trying to identify that, what we call a re-entry point, or what a lot of people will say is the time when the market is better again. We know markets tend to go up far more often than they go down, but we think more about those downturns because they hurt more, right? They cause more heartburn.
Exactly. And, it's a natural, part of the way our economy works and investing works is there are things called market cycles. There's a reason why they call it a market cycle, because it goes up, it goes down, it goes up, it goes down. The only way to get the true long-term average returns is to be invested through those market cycles. It's it's at the turning points when the market changes from falling to rising that some of the largest returns are seen. That's what you were highlighting before. If you're on the sideline and you miss that, that can be incredibly impactful.
So maybe we could put this into numbers for the people who need a little bit more proof to believe what we're saying. So maybe you could kind of quantify what we're talking about here. So consider that investor who decided to step out after the market drops, and then they missed some period of time when the market begins its recovery, or in some cases, I think, begins and completes its recovery for that phase of the cycle. So if you stayed invested, let's say, throughout, and of course, when we say stay invested, we're not saying arbitrarily chosen holdings. We're saying in a strategy that's suitable for you, that's in line with your particular objectives, your tolerance for risk, and the goals that you have ultimately for that money. But if you stayed invested versus got out to try to spare yourself a downturn and then mistimed that reentry, maybe give us some examples of what that really would cost.
Sure. So with data provided by Zephyr Style Advisors, what we did is we looked at a dollar investment in the S&P 500, the 500 largest U.S. corporations, starting in 2000. And then the analysis went pretty much 22 and a half years or 23 and a half years to June of this year, 2023. So if you remained invested in the S&P 500 through that time, $1 increased by over 5 times. It increased to $5.20. The question you posed is, well, what about if just you missed just the best month over that 23 and a half year period? What was the effect of your return? Well, actually, you lost over $1. $5.20 went down to $4.19.
So that's 20% less over that entire span of time from 2000 to mid-year 2023. You actually earned 20% less in your returns just for missing 1 month in the market.
The best month. Yeah. We can expand that. Let's say you missed the 5 best months over that period. Now that return is down to $2.83. It's
about half.
Go to 10 months, $1.85. 15 months, $1.26 over that 23 and a half year period. And now here's the one that really just can make my stomach churn. If you missed the 20 best months over that period, you actually lost 4 cents.
So the idea was you were trying to spare a loss, but in reality, the data shows you created a loss.
Exactly. That it is incredibly challenging for anyone to, time the market because of what we highlighted before of making those 2 decisions. We constantly are looking for people that have published, audited investment track records to see whether, that claim they can, do it on a long-term consistent basis. And the empirical evidence just isn't there. It's just incredibly challenging to do in the long run to be on the right side of that decision every single time which is why we think that if you have long-term planning goals, your investment objectives should be to ensure that you are taking the benefits of what investing in the equity markets can provide you. But the way to do that most efficiently is to make sure that you have your time in the market. That's key.
So that's your key. All right, great. I think, we decided to talk about this topic today because we wanted to share with people maybe a reminder that jumping in and jumping out, or jumping out and jumping back in, is a lot more complicated than we think. And if it was so easy to do, I suspect everyone would be doing it, but doing it successfully and earning money while doing it and seeing better gains, greater increases in value. And as you say, the data shows just the opposite, actually. So just sort of, the last takeaways here, I would say, if you're looking for long-term results, good returns for your investment, what's the key takeaway that we want investors to remember, always?
If you're seeking the average long-term equity return, it means that you are investing through all market cycles. Downturns will definitely lead to emotional decision making, but they can have significantly negative impact on your portfolio returns. And one last time, it's time in the market, not timing the market, that allows portfolio goals to be achieved.
All right. Thanks for sharing that. I hope it's helpful for the folks listening, and maybe it's new to them. Maybe it's a reminder to others. Either way, we think it's a good message. It's a good reminder, or it's a good philosophy to kind of stick with and try to remember it mostly when markets are in their downturn, because the upturn's easy. It's the downturn that we have to survive. We hope that this episode was helpful. We encourage you to share it with others and replay it the next time the markets head down. Thanks for listening. We hope you've enjoyed this episode of Millstone River Live. Feel free to share it with someone you think might benefit. Millstone River Wealth Management is an independent wealth management firm based in New Jersey. We form a supportive partnership with our clients and help with financial education and planning. We welcome your feedback. Send comments or questions to podcast@millstone-river.com. More information about our firm can be found online at millstone-river.com. Thanks for listening.